Guys, welcome to our channel. Before we get started, make sure to hit that like button. Also, subscribe to our channel, How to Profit in Market Downturn. So make sure to watch the full video. A bear market refers to a widespread decline in asset prices of at least 20% from recent highs. Clearly, these times are nothing to look forward to, but fighting back can be dangerous. Gary will walk you through 8 important investment strategies and mindsets to help you stay calm and play dead when the stock market takes a swipe at your returns. Keep your fears in check. There is an old saying on Wall Street: the Dow climbs a wall of worry. In other words, over time the Dow has continued to rise despite economic woes, terrorism, and countless other calamities. Investors should try to always separate their emotions from the investment decision-making process. What seems like a massive global catastrophe one day may be remembered as nothing more than a blip on the radar screen a few years down the road. Remember that fear is an emotion that can cloud rational judgment of a situation. Keep calm and carry on. Accumulate with dollar-cost averaging. The most important thing to keep in mind during an economic slowdown is that it's normal for the stock market to have negative years. It's part of the business cycle. If you are a long-term investor, meaning a time horizon of 10+ years, one option is to take advantage of dollar-cost averaging (DCA). By purchasing shares regardless of price, you end up buying shares at a low price when the market is down. Over the long run, your cost will average down, leaving you with a better overall entry price for your shares. Play dead. During a bear market, the bears rule and the bulls don't stand a chance. There's an old saying that the best thing to do during a bear market is to play dead. It's the same protocol as if you met a real grizzly in the woods. Fighting back would be very dangerous. By staying calm and not making any sudden moves, you'll save yourself from becoming a bear's lunch. Playing dead in financial terms means putting a larger portion of your portfolio in money market securities, such as certificates of deposit, CDs, U.S. Treasury bills, and other instruments with high liquidity and short maturities. Diversify. Having a percentage of your portfolio spread among stocks, bonds, cash, and alternative assets is the core of diversification. How you slice up your portfolio depends on your risk tolerance, time horizon, goals, etc. Every investor's situation is different. A proper asset allocation strategy will allow you to avoid the potentially negative effects resulting from placing all your eggs in one basket. Invest only what you can afford to lose. Investing is important, but so is eating and keeping a roof over your head. It's unwise to take short-term funds, money for the mortgage or groceries, and invest them in stocks. As a general rule, investors should not get involved in equities unless they have an investment horizon of at least 5 years, preferably longer, and they should never invest money that they can't afford to lose. Remember, bear markets, and even minor corrections, can be extremely destructive. Look for good values. Bear markets can provide great opportunities for investors. The trick is to know what you are looking for. Beaten up, battered, underpriced. These are all descriptions of stocks during a bear market. Value investors, such as Warren Buffett, often view bear markets as buying opportunities because the valuations of good companies get hammered down along with the poor companies and sit at very attractive valuations. Buffett often builds up his position in some of his favorite stocks during less than cheery times of the market because he knows the market's nature is to punish even good companies by more than they deserve. Take stock in defensive industries. Defensive or non-cyclical stocks are securities that generally perform better than the overall market during bad times. These types of stocks provide a consistent dividend and stable earnings, regardless of the state of the overall market. Companies that produce household non-durables, such as toothpaste, shampoo, and shaving cream, are examples of defensive industries because people will still use these items in hard times. Go short. There are ways to profit from falling prices. Short selling is one way to do so, borrowing shares in a company or ETF and selling them, hoping to buy them back at a lower price. Short selling requires margin accounts and could cause harmful losses if markets rise and short positions are called in, squeezing prices even higher. Put options are another choice, which gain value as prices fall, and which guarantees a minimum price at which to sell a security, effectively establishing a floor for your losses if you are using it to hedge. You will need the ability to trade options in your brokerage account to buy puts. Inverse exchange-traded funds, ETFs, also give investors a chance to profit from a decline in major indexes or benchmarks, such as the Nasdaq 100. When the major indexes go down, these funds go up, allowing you to profit while the rest of the market suffers. Unlike short selling or puts, these can be purchased easily from your brokerage account. No matter how hard you prepare, there is also some impact on your investments when the stock market crashes. A lot of experts list things to be prepared for when the stock market crashes, but what after it does? There are not many experts who have listed foolproof solutions. Not everyone is patient or financially stable until the stock prices go back up again, and in such situations, the pressure is quite high. To start off, we suggest you take a deep breath and relax your body, and the second step would be to check out the checklist below that will help you with what to do when the stock market crashes. Nothing, if you are a long-term investor. The first and foremost thing to do if you are a long-term investor is do nothing. A long-term investor has less to worry about the stock market situation, as it doesn't impact them with major hits. The reason for this is simple: the stock market's volatility. If the market is on its knees today, in the coming few days, it will be up in the sky again. It is best to do nothing as a long-term investor, as the wave continues to flow with both upward and downward thresholds. Additionally, it is an open window to buy more stocks for long-term investment as the prices are on the downward threshold. This way, you can book more profit for the future by spending only a little during these times. Invest only as much as you can after saving enough for the next 5 years. A stock market crash is no good news for the short-term marketers, and it is always disturbing. The common reason for this is the money involved in the market is actually the money taken as a loan or by submission of entire assets. We do not recommend any marketer who invests money in the stock market without saving enough for the next 5 years. A stock marketer needs to be intelligent and know the stock market's volatility. Blindly investing in the stock market is no good and will ultimately lead to heavy losses. If you are investing in stocks today, ensure you have enough fuel left if the money is taken away. A trick that I personally use is to invest certain money in the stock market, which is meaningless to me. So, even if the money is drowned tomorrow, I am still running with a regular stream of income. Diversifying income portfolio. As a clever marketer, one should also build assets outside the stock market that can ensure continuous money flow even when the stock market crashes. Diversifying the income portfolio can reduce the impact of the stock market crash. We suggest you build more and more assets when the stock market is working in profits for you. A continuous running stream of income ensures you are financially stable even after the stock market crash. Start today and build a strong and more diversified income portfolio excluding the stock market. As the saying goes by Warren Buffett, don't put all your eggs in one basket. We suggest you do the same, be diversified. Buy more stocks if you can. There is a perfect opportunity to buy more stocks when the market crashes. If you have saved enough and have other assets that generate income for you, this is the right time to buy more stocks. The reason for this is simple. A stock market crash signifies all the prices are down, and this is the perfect opportunity to buy low and sell high. We all know the thumb rule of the stock market: buy low and sell high. In the case of a stock market crash, you can buy more short-term and long-term stocks that will book profits when the market is up again. But are you going to buy the stocks blindly because they are at a low price? I bet that would be a mistake. We get it. The stock market crash is luring investors who want to buy more, but that does not mean you can buy stock blindly. Here, as a stock marketer, one needs to have patience and solid research of the company. This research includes important data, such as the estimation of how long it will take the companies to raise the stock prices by giving a great performance if the expense ratio and other statistical data point the investors in the right direction, and if the stock market crash has, directly and indirectly, impacted the company in a way that can disturb the performance of the companies. After all of the above is taken into consideration, one can invest and book more profit after the stock market crash. However, all of this hard research needs to be done in minimum time before the stock market crash impact is reduced and the prices rise again. What do you think of our video? Let us know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also remember to subscribe to our channel and enable notification, so you will be the first to know when we upload a new video. Thank you for watching.